run here of several calls back to back, rather than our usually twice a month because we have so much going on. Very glad that that's part of the scheme. I'm going to alert people around a couple things that are coming up, so that people are familiar with the schedule. And so next week is going to be round 2 of our short sale workaround program, where we're going to go into a lot more depth about how to do these workarounds so that we can help people who had short sales have the shorter 4-year window rather than the 7-year foreclosure window, because they're being mislabeled in the automated underwriting systems. So we'll have Pam and Ellie back, and they will kind of do the deep dive and walk you through each step. It'll be very much in the weeds. So this is really one aimed at people who are very interested in doing this kind of project. And I've also asked them to talk a little bit about how to market this and how to actually get clients in that would be potentially paying clients. But it's lots of potential in the program. Secondly, we have next week we'll have the Nationwide Mortgage Collaborative with Gabe Del Rio from Springboard CDFI. And hopefully you've heard about this, but even if you haven't, it's essentially a nonprofit sponsored mortgage platform that is quite elaborate and quite well developed. It's also, they have committed to pay for housing counseling and have one set of fees for accepting applications from clients who've been counseled, and a second set of fees for if you're submitting docs. There's a lot of thought that's gone into this. A lot of high-performing CDCs have contributed to the process and helped to test it out. So this is part of their now beginning to expand around the country. Very exciting. It's important for us, I think, in the future, is really taking some of the tools of the industry and applying them in a nonprofit context to really help both create more opportunities for borrowers and provide some funding for the counseling work. So definitely plan on attending that. So that's in 2 weeks, and we'll have our regular schedule beyond that. And then we'll have, and one more quick headline, which is we are looking forward to having our latest national meeting, and that will be in Washington, D.C. It's July 26th and 27th, and start in the afternoon of July 26th. And we'll also have, and the whole idea will be we'll be doing some serious advocacy work around our work. We'll also have opportunities to spend time with the RIS and with MBA. We're hoping to bring in as well NAREP and NAREB. And there'll be a variety of things that kind of reinforce our work and the ideas. We have set this as a deadline for a couple big projects, and we'll see if the opportunities and the lenders actually step up and do it. So there'll be a lot of good things out of it. And if you've ever been to one before, you know it's kind of a high content, high advocacy session. We'll invite in some key politicos as well. And then and that evening, between the two meetings, we'll have dinner and drinks at the Bank of America penthouse room, or whatever they call it. They always do a very nice presentation there, and overlooks the Treasury Department. And we'll probably bring in some friends that you can network with there as well. And this is always a fun thing. So registration will have to work out a few kinks on how to do the registration this time, but we'll be rolling that out in the next week or two. And please sign up. It's actually limited seating this time, so usually we have 80 to 100 people. This time we may be limited to 50 or so. We just the space is that big, and we need to have room for our allies as well. So keep an eye out for that. It'll be in the next week or two that we roll out the. So those are my highlights, and which I'm anxious for us to move on to. Nadia is not able to join us, so it'll be Matt Hull, who's with Texas Association of CDCs and also Texas Community Capital. Matt, are you with us here?
Yes, I am.
Good, excellent. So take it away. We're eager to hear.
Great. Hi, everyone. My name is Matt Hull. I'm the Executive Director with the Texas Association of Community Development Corporations, and I'm the administrator of a loan fund called Texas Community Capital. Under Texas Community Capital, we have a program called the Community Loan Center, and we operate as the Community Loan Center of Texas for our lending activity, and then the Community Loan Center of America for our expansion work. The Community Loan Center was created by a CDC and CDFI out of Brownsville, Texas, called the Rio Grande Valley Multibank. And we work in partnership with them. They administer the program, and we help market the program around the country. Since we're a trade association, we have counterparts and colleagues working in similar trade associations in most of the 50 states. Go ahead and go to the next slide. And so what we're talking about today, the Community Loan Center is a payday loan alternative. And starting about 20 years ago in Texas, we started to see the proliferation of predatory lending operations in low-income communities. And for the last 20 years or so, we've been trying at the political level and at the policy level to fight them. And about 8 years ago, decided that we probably, realistically in Texas weren't going to have a lot of success curtailing this behavior at the this line of business at the policy level. So what we really needed to do was to create an alternative to payday predatory and auto title lending. So what we noticed is that Texas has some of the most lenient payday lending regulations across the country. 1/5 of all payday loans and about 1/5 of all of the profits derived from payday and auto title loans is inflicted upon low-income individuals in Texas. So, in fact, the same business located in Texas are 664% a lot less in Oklahoma and in Florida. Next slide. It looked like in a small town like Waco, Texas. Waco, Texas has a population of about 200,000. Located between Austin and that small town. They had 33 payday and auto title lenders in 2015. Those people who use those services paid $21 million in interest and fees, and 472 cars were repossessed just in 2015 in that one town. Next slide, please. And so, but what does it look like in our largest city, Houston, Texas? In Houston in 2015, they had over 700 payday and auto title locations. 344 million in interest and fees was charged, and over 7,000 cars repossessed. In 2015, there were just over 3,100 payday lending locations. It's a $6 billion in fees going back to the payday loan companies, and over 37,000 cars repossessed. All of that means is that low-income individuals in Texas, if they need access to credit and they don't have it through conventional means, their only recourse is a predatory loan. Next slide, please. And the main takeaway here, in Texas, over 700 cars are being repossessed a week. Basically, the lifeline for many families in getting kids to school, getting to jobs, staying employed is being stripped away from them. 32% of the individuals that are going in for social services through groups like Catholic Charities are saying they're there because of financial stress caused by a payday loan. Next slide, please. This. And they build about 100 families coming and the financial hardship. It's an uncollateralized, unsecured loan. The borrower just has to be employed by a company that signed onto the program, 18 years of age or older, have been at that company for more than 90 days, have a valid photo ID, and that photo ID is tied to a bank account where we can electronically transfer the funds. We do, however, underwrite the business, and we look a lot at how do we analyze companies and how do we analyze businesses and industrial sectors to move into. And we look a lot at their turnover rate for, how many employees did they let go or quit a year, and how many did they bring on. No prepayment penalties, as I said, it can be paid back any time. And so with all of that combined, on a weekly repayment on a $1,000 loan, it means they're paying right at $23, and over a month it's about $94. Next slide. So how does our loan compare to what some of the other conventional products are out on the market? The blue line at the Loan Center loan looks like our average loan size is $941, and over the course of that year, that borrower would pay us back $1,056. Compare that to the blue line at the top, which is a single payment deferred payday loan. That borrower would be paying back $5,200. An installment payday loan, they would be paying back $4,300. For an title loan, which carries a slightly lower interest rate, $3,200. And an installment title loan, it would be right at $3,000. So just given those numbers, you can see the benefit of the Community Loan Center back to the borrower. We estimate that on a $1,000 loan compared to a typical payday loan in Texas, we're saving borrowers per loan. Next slide, please. So who are we? And we can go to the next slide as well. The Rio Grande Valley Multibank, that is a for-profit CDFI. They have, I believe, 10 bank equity investors. They are affiliated with and owned and operated by the Community Development Corporation of Brownsville, which is a CDC building affordable housing loans, doing homebuyer counseling. They build about 100 homes a year. They manage the Rio Grande Valley Multibank. They own the product. They are technically, because fortunately or unfortunately, they're a for-profit organization, CDFI, mission-based. Because of that, we have to be structured as a franchise system. So they're, as the owner of the product, the franchisor. My organization, Texas Community Capital, and the Community Loan Center of America, we're their sub-franchisor. So we license the all of the technology and intellectual property from the Rio Grande Valley Multibank, and then we recruit local organizations who want to bring this program to their community. We sublicense all of those, all of the technical assistance. We sublicense all the intellectual property, all of the rights to and usage to the local lenders, who are then the franchisee. The role of the franchisee is then really, once they join the program, to recruit local employers, market to those employees, and then raise loan capital by which the loans can be funded. All of the loan servicing and the loan origination work is done in Brownsville, Texas, through the Rio Grande Valley Multibank. So the local CLC lenders have a loan origination and servicing agreement back to the Rio Grande Valley Multibank. Next slide. So it's just a graphical representation. At the very top in blue is the Rio Grande Valley Multibank. They own and manage the software that runs this program. They do the loan processing and servicing. My organization is in the teal color box. We provide support, technical assistance, training, and outreach to the local lenders that we've recruited around the country. The orange box is hopefully the local organizations who sign on to bring the program to their area locally. They again recruit employers, market to employees, raise the loan capital, and then they collect the interest and part of the fee to help pay for their services. They go out and recruit the employers, who then in turn agree to do payroll deduction to pay the loans back and allow the franchisee to market to their employees. And then the employee borrower, they go online, apply for the loan, sign the loan documents electronically, and then they agree to have the repayments paid back by the employer through payroll deduction. So next slide, please. And so there are numerous benefits to the employers. And we always get asked, what's the major impediment to getting employers to sign up? And the main major impediment to getting employers to sign up is getting them to understand that their employees are already using payday loans, that they're already being taken advantage of, and that there is a better, more sound financial product out there that's available to them that requires no cost to the employer. It does require time for them to verify employment and to set up payroll deduction, just like they would any other payment. There is this growing body of evidence in the human resource field around what's called presenteeism and the cost of presenteeism. Now, presenteeism is very much like absenteeism. We know what that is when someone's not on the work site. But presenteeism, where someone shows up to work every day, but they're just mentally not there, it's a cause of financial loss back to the employers. The leading cause of presenteeism is someone going through a divorce. They're not as productive. They're not as sharp on the work site. The second leading cause of presenteeism in the workplace is financial stress. At least that's what the research is showing. Next slide, please. The system structure is based on it's an online platform called the Kin software system. It's technically what's called a software as a service, so everything is done in the cloud. Everything is stored in San Antonio, Texas, with a group called Rackspace you might be familiar with. So it has an online platform. Loans can be applied for anytime, day or night. It's open 24 hours. There's 5 access points. The Rio Grande Valley Multibank administers the program through the system. The local lenders have access to see what their loan portfolio is doing, who's borrowing, who isn't. and can operate and manage their part of the process through their portal. The employer has a portal to where they can go in and set up payroll deduction. If someone leaves their job, they can terminate them, and then the system automatically knows to pull the payments out of their bank account that's on file with us. Then there is the online application that would be linked to the local community loan center's website, and that's the website that they market to eligible borrowers. And then the borrowers have a portal where they can go in once their employment is verified by the employer. They can go in and electronically sign their loan documents. They can go in, they can make additional payments, they can pay off the loan early, they can check their balance, that sort of thing. So everything is automated. It makes it fairly simple to do. Next slide, please. So, and you can just scroll through these. These are just screenshots of what the software looks like. That's the welcome page. That's the application page. Just keep going. Here's some of the administrative portal where you can do things like verify employment if you're the employer. If you're the administrator or the local lender, you can see what your loan balance is. You can see what your interest earned and accrued is, that sort of thing. Baltimore, Maryland in the very near future. Our goal is to do 10,000 loans within these new lenders, 10,000 loans over the next 2 years as well. Last year, our 9 active lenders that were operating did 10,000 loans just in 2016, putting our total just over 20,000 over the history of the program, which started lending in October of 2011. Long term, we want to build a sustainable program for organizations across the country to engage in, and we want to make capital at a very affordable rate available to people who don't have any other access to credit. We look at it as, if we don't make 10,000 loans over the next 2 years, let's say we only make 7,000 loans, and if we're not saving the $750 per loan that we estimate, let's say we're only saving $400 a loan compared to a payday loan, that's $2.8 million we're putting back into the local economy that isn't being exported as profit to a payday lender. Next slide. So we look at, we do a lot of evaluation of the program. As you can imagine, our funders and other people who are investing in the program really want to know what's going on with the program. So we're able to provide them at pretty much any point in time, total loans originated, total amount of capital lent to the borrowers, loans originated per location and employer, delinquency rates, default rates, number of CLCs operating, estimates on savings per borrower. And we're finishing up some research with some of our advisory board members with Texas Appleseed, which is a policy group here in town, and Texas A&M University, looking at what the impact of the borrowers' lives are and their financial health and security. So next slide, please. And so, as I mentioned, we have an advisory committee. It's not just me out there in the wild running this program. We've got some very thoughtful and well-positioned thought leaders on the program from around the state, and now it's expanded nationally as well. Next slide, please. And our success to date, and I just have some new numbers that I wasn't able to update on this. In the first year of operation, when it was running just in Brownsville, Texas, they did just under 800 loans, and that was from October of 11 through September of 12. Just last year, from January 16 through December of 16, we did right at 10,000 loans. Collectively, as of February of this year, we surpassed our 20,000th loan. We've lent out, it's now about 16 million to borrowers across the network. We've recruited across all of our markets. It's now about 135 employers. We've got right at 75,000 eligible borrowers. Over the last 18 months, our loan loss network-wide has been, I think it's ticked up. It's about 2.4% now. Delinquency rates are a little higher. They're in the 3.1%. And we've saved borrowers somewhere in the neighborhood of, now we're estimating it's 11 to 12 million over the last 5 or 6 years. Next slide. So this just shows the cumulative loan production over time. The big blue box at the bottom, that's the Rio Grande Valley Multibank. And then you can see where the other lenders like Community Loan Center of Dallas or the Community Loan Center of the Brazos Valley have come in, and how all of our cumulative production is just over 20,000 now. Next slide. So we do have nationwide expansion plans. As I mentioned, we're in 9 markets in Texas, 2 in Indiana, 1 in Baltimore. We have interest and applications to join the program from groups in Missouri. We're working with groups in Alabama. We'll be in Michigan in a couple of weeks at a community development conference talking about the program. And what we hope that we're able to do is we hope that we've been able to design this as really a plug and play program for interested organizations around the country to implement. We take all of the startup cost out of the equation. You don't have to write your own software or get software off the shelf. We have all of the marketing materials for you. We help you write your business plan if you have to submit that to your statewide, if you have a statewide lender, lending regulatory agency. Here in Texas, it's the Office of Consumer Credit Commissioner. They license organizations that do this type of consumer lending. Most other states have a similar requirement that you be licensed at the state level. So we help prepare those documents for you if you need to. We do all of the training and technical assistance through a 12-part webinar series. We even have an online store where you can go in and buy branded merchandise, flyers, logos, business cards, table skirts, just things that might help you get moving faster, and do it in a way that's very cost effective. Next slide, please. So bringing this to your area, if you think that your organization is interested in learning more about what this program would mean and what it would take to implement it, please let us know. The first thing would be to contact us, and we would set up a time to visit with you and to see if it makes sense for you to commit to being a local lender. We only have 1 local lender per area. We help control the brand. You would be licensed as the Community Loan Center of your city place. And we would help you establish a goal for fundraising. That would be what we think would be necessary to start would be $250,000 to $500,000 in loan capital. We're able to make some of those loans to you through a nationwide pool that we've been able to help create. We would help provide you the marketing materials to recruit employers, and we would help encourage you in ways to go out and raise funds for both administrative expenses and for lending capital through banks and foundations in your area. Happy to share some of the grants that have been successful in the language that we've used to raise capital in the past. Next slide, please. And so from a local lender perspective, what does this mean from the revenue and the cost side? On the revenue side, you would earn that 18% interest on the loans that you're making. Right now on a $1,000 loan, that interest is coming in right at $96. And then you would earn $9.50 of that $20 origination fee. You would pay $10.50 to the Rio Grande Valley Multibank for setting up the loan and for the cost of the software, because they have a per loan fee that they pay their software development company. They didn't have to pay anything up front to get it done. There are fees associated with it. In addition to that $10.50 of the $20 origination fee, you would pay the Rio Grande Valley 45 basis points per month on outstanding loan balance. That's for servicing the loan. That works out to about $35 per loan per year over the life of that loan. There's an annual franchise fee that helps pay for the use of logo and update of the websites. That's $2,500 fee. And then any state licensing fees or insurance that you would be required to have in your state, that would also be fees that you would have to pay. Next slide, please. So there are funding and investment options. This slide we include really to help say that there's help out there from us and other local lenders in how to go about raising capital and getting investors into the program. We have a goal of creating a $1.5 million nationwide loan pool that my organization can help use to seed local lenders as they come in. We're at about 700,000 now, and we're talking to potential funders, every month. Next slide, please. And so what are we asking? We're asking that you and your organization consider bringing the program to your area, becoming a licensed lender in your state if that's what it's required. You'd be required to pay the $2,500 annual licensing fee to dedicate a staff person to this program. What we do not want individual organizations to do is to try to implement this program and not dedicate the resources necessary to make this program. This is not art. This is not a consumer program. In order to make it work and make it sustainable, and so we want to be very up. It would take it the employers and you would have to. We ask for any kind of proof of insurance. The loan agreement. You can scroll through this, and I think the contact slide. Employer is an employer of 4, and it's a family-owned tire shop, I believe. The organization with the most employers signed up. They have about 80 employers signed up. They have about 20,000 eligible borrowers within those 80 employers. We have an organization that only has 6 employers, but has right at 19,000 employees. They've taken a different approach. Their approach is we're only going to recruit very large employers. It takes them, they estimate, the same amount of time to recruit a very large employer as it would be a small employer. And so they want to maximize their efficiency and get the most employees for the employers that they recruit. So what we suggest and what we recommend, what I find to be the best way to mix or to create a portfolio of employers is to start with your public employers first. They tend to be the most stable, not as much turnover as in the private sector. They also tend to not pay as well, but they typically have really good benefits. So oftentimes employees of public sector employers need access to capital, but because they have good benefits, they're sometimes not as job mobile. They're not as willing to switch jobs because they have a good benefit system. So my suggestion, what I find to be a successful way to build the portfolio, is to start with your public employers, and then once you have a base of 500 to 6,000 eligible borrowers, you've made 1,000 loans, then start reaching out into the private sector.
Yeah, hospitals would be a good place to go as well. They have a workforce that's mixed of, but lots of low and moderate income people actually work at hospitals and the support staff. Yeah, good. Okay.
We do have one hospital signed up in Dallas, Texas, and They have right at 10,000 employees, and many of their employees have borrowed from the Community Loan Center of Dallas.
Fascinating. So the hamburger of consumer lending. So Matthew, have you got questions? We have questions in the queue?
Yep, there's a number of questions, and just a reminder to the folks that if you do want to ask a question, you can use the question box. We'll run through what we've got. So the first question is, will these appear on credit reports, and will timely repayment specifically appear on credit reports?
Right. That is also a great question. That is up to the local lender. We cannot centralize credit reporting back to the credit bureaus. We encourage the local lenders to sign up and report those back to credit bureaus, but we cannot mandate it as part of the administration of the loan program. Just like financial counseling and coaching, and I failed to mention this, financial counseling and coaching is not required as part of the program. What we require is we will only sign up a community loan center as a lender if they have a mechanism by which to provide financial counseling or coaching at no cost to the borrower if it's requested. We can't mandate it, and when you mandate it, unfortunately, people take the path of least resistance and we just go to a payday lender. But what we encourage local lenders to do is to periodically reach out by text or by email and say, hey, you have a community loan center loan. Please be advised that if you would like, you have access to these services, and that includes free financial counseling and coaching, and then to be able to follow up with anybody who wants that.
I think that pretty well covers the next question.
Oh, okay, great.
There were a couple of questions just about the technology. Could you just kind of go back over quickly, how it works that the local lender would kind of acquire the technology, what happens on their end, what they need to do?
Sure. How they acquire the technology is through an MOU and through the contracts that we would have with them. We have contracts where we sublicense the technology to them, and basically it's just going to a website. And we would give them a link to that portal. They would have a login and password, and that's how they access the site. There's not an executable file to load on your computer. Everything is done through the internet, and it's all cloud-based storage. So that's how they access it. It's only available to those people who sign up as lenders, and then they would give access to each of their employers that they sign up. They would have a portal that we would assign to them. Those typically it's going to be the payroll department or someone in human resources would have access to go in and verify employment through the system. And then we would give a link for the online loan application for the local lender to then put on their marketing materials to direct their borrowers to that website to fill out the loan application.
And just to be clear, there's nothing that the local lender, it's basically all done for you. You just have to access these things. They're not going out with an application. They're not doing any of that. Great.
Nope. Everything is stored in the cloud. Once we work with them to make sure that all of the documentation, particularly the first lender in a state where we haven't worked before, we would work with them to make sure that the lending documents, the loan agreements, everything signed by the borrower meets their state laws and state regulations and pass inspection by whichever state entity regulates these types of loans. And once that's done, it's uploaded into the system. It's generated automatically. They don't have to have a programmer on site. They don't have to be experts in web design or anything like that. We really try to make it as simple and as plug and play as possible.
Great. Someone asked, is $1,000 as the max loan? Is that hard and fast, or if if with a certain employer, or if the employee had a certain amount of income, would it ever be possible to go above $1,000?
Right now, there's no way to go above $1,000. And in one state where we have interest, we're investigating, we may have to cap our loan at $999. because once you get to $1,000 and above, it becomes a different set of regulations that that the program may not be able to work under. But right now, the maximum is $1,000. This is set up as an alternative to payday lending. The typical payday loan in Texas is about $400. So we thought, okay, if we can go a little bit above that and give people a little bit of breathing room to pay off some of the high interest and fees that have accumulated on those loans, we're doing them a service. We don't want to create a burden for people. We don't want to trap borrowers in a cycle of debt by letting them borrow more than they can afford. Right now, with monthly gross income of $2,000 or more, the loan repayments are right at or below 5% of their income per pay period, and that meets all of the general standards around what a good consumer loan should look like. So our program meets all of the CFPB has provided as guidelines for small dollar loans.
Great. What percentage of default is typical?
I'm sorry, could you repeat that?
The typical default percentage.
Oh, sure. Over the last 18 months across all of our lenders, our default rate at, I believe it's 2.4%, and our delinquency rate, of which not all of those loans will default, is, I believe, right at 3.1%. Most of our lenders are under, 3% loan loss. We may have one that's above it, but it was because they had one employer who maybe went out of business or something that, some external factor has led to that. The ability to repay this loan through payroll deduction is the key in keeping delinquencies and defaults down, and it's a key part of this program. We can't mandate that employees or that borrowers select that. It's the default option in the software, but if they want to choose to have us ACH out of their bank account, or if for some reason they stop payroll deduction, all of the lending agreements allow us to go in and pull money out of their bank accounts to repay the loan.
Right. Could you talk a little about the state licensing fees? They asked what they are on average, but maybe if there's a range, or if you could just talk a little bit more about what those look like?
Yeah. So from my experience, here is that fee. There's an application fee or a setup fee of $800, and then there's an annual fee that could go from roughly $600 to, and in other states it varies. So in Indiana, for instance, I believe it's a $2,000 setup fee and a $2,000 annual licensing fee. And in Baltimore, I believe it's $1,000 application fee and $1,200 annual licensing fees. Those are the only states that I'm familiar with. In some states, I'm not sure that there is a fee, and in other states, it may be higher than those that I just quoted.
All right. So someone wrote, I'm excited about this idea, but I wonder about meeting our CDFI certification requirements. Do you track ethnicity or AMI of borrowers?
So that's a great question, and I wish I had a definitive answer. It's something that of all of our lenders right now, I believe 5 of us are CDFIs, and each group has a different need. And so one of the things that we're trying to figure out at this moment is the way income with federal lending laws around equal access, and still somehow collect data on ethnicity, since some CDFIs use that as their investment criteria. Right now, we collect we collect income data only for the borrower. So we don't collect household income, and we're trying to figure out how can we collect household income and size of household for those CDFIs who need that information. Most of the other CDFIs put through geography, and they've figured out ways to geocode their data where their borrowers live and are able to meet their CRA obligations that way. I'm sorry, CDFI obligation that way. So it's something we haven't quite figured out in the application, but several of our lenders are asking us to look into it and are helping us look into it.
Great. a couple real specific questions. Who's your partner in Houston, Texas?
The Houston, Texas partner is historically they've done economic development and commercial revitalization in Third Ward, and over the last 10 years have gotten into affordable housing, and they're just in the launch phase of getting going. So they're still raising loan capital at this point.
All right. And you mentioned you'd be in Michigan at a community development conference. When and where is that?
That conference is in Lansing, and I believe it starts Sunday, April 30th. My presentation is going to be, I believe, after lunch on Monday, May 1st, and it's the Michigan Communities, I don't have it in front of me, but Building Communities Conference, hosted by CEDAM and several other organizations in Michigan. And we're delighted to be going. If you're going to be at the conference, please come by and say hello.
Awesome. Someone asked if you could talk a little more about the underwriting. They said, is the relaxed underwriting under lender control or yours? And can you give us an example, for example, credit score, et cetera?
Right. And so we don't collect credit scores, and we don't ask for it. And in order for us, I mean, you know, the simplest way to describe the underwriting is it's relaxed. We really encourage organizations, lenders, community loan center lenders, to research the companies that they're bringing into the program, because the only qualifications for the borrower to apply for and have a loan funded is that they're 18 years of age or older and have been there for 3 months or more, have a valid photo ID on file with the employer, and that name and typically social security number, we require social security numbers, is tied to their bank account. And we do behind the scenes, there's all kinds of federal registries that we run this information through that we're required to. But that's really it as far as the underwriting. We don't look at credit scores. We don't look at lending history, any of that information. And so even by doing that over 20,000 loans, we still have a very acceptable delinquency and default rate.
Great. Someone asked if you've done any analysis of how this lending has affected volume at payday loan companies, or if you have any data on how many of your borrowers had used payday loans previously.
We have some preliminary data from that report that Texas Appleseed and Texas A&M are doing. I don't have it in front of me, and I don't want to misquote it. There's a lot of facts and figures in there, and I've only seen a draft. It was somewhere around like a quarter of our borrowers had access to payday lender in the last couple of years, something like that. But when that report comes out and it's finalized, we can send it to you, and it'll probably be available on the Texas Appleseed website. But there is overlap between payday loan clients and our borrowers, and we know just anecdotally from talking to people on the phone, doing customer service calls when people call us for information, is that a fair number of people are using our loans to pay off another high-cost loan.
Great. A couple of people asked about if you could talk a little more about what the income stream looks like for your current lenders. Someone said, what's the average income stream? How is it paid? Someone else asked, how much does the CDL earn in a year less expenses? So could you just talk a little bit more about what the income streams have looked like?
Sure. The income stream just depends upon the volume of loans that are being made. On a $1,000 loan, you're going to earn somewhere around $105. From that, you're going to have about $35 worth of fees back. Well, you're going to pay, yeah, that's right. You're going to have about $35 in loan servicing fees of the lifetime of that loan. Your cost of capital will take money out of that proceeds as well. So if your cost of capital is 2%, you're going to pay about $11 on that loan in expenses, in interest and fees. If it's at 3% cost of capital, that's $18. If you don't have a separate loan loss reserve fund, we would recommend setting one up, or paying yourself for a loan loss reserve through the proceeds of the loan. So that could be 3.5% or 4%. So that's $35 or $40 you want to set aside on every $1,000 loaned out to cover any losses at the end of the year. And then there's state licensing fees. There's increases in insurance that if you're required to do that at the state level, just various things like that. Puts the per loan profit somewhere in the $10, $15, $20 range, depending on your administrative expenses. So then from there, you can take a look at what your earnings would be if you did 1,000 loans a year, 2,000, 5,000 loans a year. Our largest lender right now is doing right at 5,000 loans a year. They're more than breaking even. They're covering all of the lending expenses and generating rev back to the organization. Some of our smaller lenders still haven't broken even yet. Their loan portfolios and loan volume is much smaller, so they're still having to subsidize the program through grants or other means. But we estimate that an organization's break-even point would be somewhere around 200 to 250 loans a month on average.
Great. Someone asked, just to be clear, the interest rate is fixed at 18%.
The interest rate right now is fixed at 18%, but depending on the time frame in which that person borrows before their first loan payment is due and the number of times that the loan is serviced over the course of that year, whether they're paid weekly, monthly, in conjunction with that $20 origination fee, it puts the APR somewhere between 21.5% and it can go up to 23, 24%, just depending on various factors of when that first loan payment is due, what the time frame is, et cetera.
Great.
No. The only way that the program works currently is through employers. We've tried to figure out ways to incorporate what we would loosely refer to as affinity groups, meaning could a client who is going through homebuyer counseling or credit counseling with a credit service organization be eligible, and we just haven't been able to figure it out yet. It really is that nexus back to the employer to make the loan repayments through payroll deduction that really makes this program work.
Great. If you could just talk a little bit more about, it sounded like you were saying that you only have one lender partner per area. If you could talk a little bit more about kind of the geography, and then very specifically, someone asked if there's anyone in Kansas City, Missouri, and Kansas.
There's not anyone in Kansas City, Missouri, or in Kansas at the moment, so you're free to apply. Just like other national organizations like Habitat for Humanity or United Ways or Goodwill Industries, they only have one per area. It's really to prevent confusion in the public's eye. It's really to prevent, in our case, more than one local lender trying to approach the same employer, or for going out to raise lending capital for that market. So for us, because we do the same basic name, the Community Loan Center of Dallas, the Community Loan Center of Kansas City, we do it as a way to really help minimize confusion in the public's eye, as well as in employer eyes as well.
Great. I'll just mention there have been some questions about whether folks can have a copy of the presentation, which I believe Bruce already circulated, but we can circulate again. And there will be a recording posted on our website. Probably not until Monday, though, but we will have a recording posted. Someone asked, with the franchise fee, is it just always going to be a flat fee, or is there any flexibility, I guess, based on the population in a given area?
Great question. Right now, we only have it as an annual flat fee of $2,500. We do allow people to pay multiple years at a time. The contract is set up as a 10-year. I'm sorry, it's a 4-year license. So roughly, you would be paying $10,000 over that 4 years. We haven't considered or thought of a way to prorate it based upon your size or the number of population in your area. What we have done is we've worked with other lenders to take in a larger population by expanding their footprint. So our smallest footprint organization right now is one county. It's they have access to lend to recruit and lend to any employees through employers in one county, but our largest is a 20-county area. Now, the population is different. That one county has, 4 million people in it, as where the population of those 20 counties is only right at 800,000. But instead of working in one small town or in one county, we've allowed them to expand to cover a greater potential employer base as well as population base.
Okay. Somebody asked who the partner in Baltimore is.
It's NHS of Baltimore. They're part of the NeighborWorks network.
And more of a comment, someone just pointed out that Maryland has a bond requirement.
We're still working through that. There are several conflicting laws around consumer lending in Maryland. There are several different sets of potential regulations we can fall under. We're not actively lending in Maryland at the moment, but we're getting closer every day. So yeah, I'm not working with that particular potential lender, but the people that are, yeah, it's moving forward. It's just moving forward slow because of some antiquated requirements. Great.
And someone essentially just made the comment going back to the providing free financial counseling that they various reasons, and essentially the question is that a fixed thing that there can be no charge for counseling?
We don't. We haven't considered it right now, but right now it's required that it's at no cost. But no one has come to us with a compelling reason that they would need to charge for it, or they weren't charging for it as part of their normal course of business. So I'm not sure it's written in stone. It may be flexible, but we would certainly need to know more about why you would want to charge for it.
All right, and the final question, hopefully it makes more sense to you than me. Recourse, question mark.
Recourse. So what I take that to mean is, what are your recourses in case someone becomes delinquent or defaults on a loan? The initial answer, when someone misses a loan payment for whatever reason, the servicers at the Rio Grande Valley Multibank try to do what they can to reach out. They make phone calls. They will ACH out of their bank account. If they hit insufficient funds, they will do it once or twice, given whatever the loan repayment schedule was. If they're still delinquent, they go back to making phone calls. And then after 120 days, they write the loan off. The loan then reverts back to the local lender, who then has recourse to go after and try to get collections through whatever means they want to pursue. Some groups hire a collection agency to follow up. Some are trying to sell their delinquent portfolios for pennies on the dollar to someone. But that's currently the recourse that the borrower has on delinquent or default loans.
Okay, and so they clarified, does the original lender buy the loan back does not apply if the lender is using its own capital. So I think that
okay, right.
Cover it. Okay.
Yeah.
That is all the questions we have. Thank you.
Great. Well, my contact information is there. If anybody wants to reach out, please feel free, and look forward to hearing from people out there.
Excellent. Thank you very much, Matt. Kind of perfect timing. We're at the top of the hour here with 1 more minute to go. So quick reminders. Next week, we're going to do the follow-up training on the workaround for returning borrowers, the short sale program, next Thursday. And a week after that, what I think is going to be very exciting is this, the Nationwide Mortgage Collaborative, an opportunity to work with other nonprofits and as a fairly aggressive payment program for housing counseling agencies. We'll have Gabe Del Rio from Springboard CDFI giving us the rundown. And this is a quickly growing network, so it'll be very valuable for people to participate. Please also keep in mind that we are still a membership organization, and would love to have your membership if you haven't joined already. We've got 1 more new member this month, so appreciate that a lot. And I think people are doing a great job in terms of renewing. As you can guess, our ability to do the advocacy work that we do really depends, and have the flexibility to do this kind of work depends on membership. And I have to say the counseling community, we understand, is under a lot of stress. You've all been very supportive, and we deeply appreciate that. We'll keep working on trying to build the counseling world. We're deeply involved with these initiatives to figure out how to flow more clients to counseling agencies and how to get paid for the work that you do with those. Hopefully we will have some of that come to fruit by the time of the national meeting on July 26th and 27th. With that quick note, everybody, we'll talk to you next week or the next 2 weeks. I hope you have a good, productive week between then. Thanks so much. Bye.